Hey everyone, welcome back to LAGFX. Today we are going to be diving into a topic that might actually surprise some of you. Why trading Forex is a bad idea. Now, before you hit the dislike button and start questioning everything, just hear me out on this. This video isn't about discouraging you guys from trading Forex. It's about shedding light on the risks, realities, and challenges that Forex trading brings, especially for those beginners. Now, Forex trading can be extremely tempting, but it's not for everyone. So, with that being said, let's dive in to why it might not be the best idea for you to trade Forex. Now, the first thing that pops to mind for me is lack of education. Now, this is a big one. I think in any professional industry, if you lack the education behind it, you're not going to do a very good job when it comes to taking part in what it is that you're doing. Now, I don't know what it is about the Forex industry, but a lot of people jump into the Forex markets thinking it's as simple as predicting whether a currency pair is going to go up or down. Spoiler alert, it's not. Forex trading requires much more than a hunch or a guess. It demands an understanding of complex factors like market psychology, economic indicators, and technical analysis. Now, many traders overlook how intricate the Forex market really is. For example, terms like pips, leverage, and lot sizes can sound foreign if you're not properly educated. More importantly, without the knowledge of how macroeconomic events like interest rate changes or geopolitical tensions affect currency prices, you're essentially gambling. Education is not just recommended, it's essential. Forex trading without the right knowledge is like trying to drive a car without knowing how to steer. So what I'm going to do is I'm going to run over some key examples that I've just touched base on there: pips, leverage, and lot sizes, what they mean, why we need to understand what they mean, and how they help us in the world of Forex. So, as I say, pips, leverage, and lot sizes. What are they? And what do they mean? Well, if we just pull our screen up here, I have just written out a little bit of information about each thing. So starting with pips. Pips stand for point in percentage. Now, when we talk about pips, we're essentially talking about the change in price and how we read the change in price. Now, when we look at pairs like the Australian dollar, the US dollar, the euro, and the Great British pound, they are all read in the same way when it comes to points in percentage or changes in price, whereas the metals such as XAU or XAG, which is your gold and silver, they are measured differently, and again, so is the Japanese yen. We have the Australian dollar to the US dollar market on screen here at the moment, so what I'm going to do is just run a quick example on pips itself and how we can read them with these pairs. So you can see here that we have three different prices on the right hand side. The one in green is our take profit, so this is where the trade would close when price has reached enough profit that we are happy with. The gold price here is our entry point. This is where we are entering in on the trade in our short position. This example here is a short, which means to sell into the market. We want to see the price go down. And the red price here is our stop loss. This is where price will automatically close our position if it surpasses a certain point where we no longer want to be involved in the trade, taking us out at a minus. Now, the first thing that I would always recommend doing when it comes to these currencies, which are the AUD, the US dollar, Great British pound, and the euro, is I would always take off the last number. So you can see in this example, the last number is actually a 0. So I would take off these last numbers. Why? Because these are micro pips. 0 to 9 is essentially 0.1 to 0.9 of a pip, which means that they are essentially irrelevant, because what we are looking for is for at least a 1 pip move up or down at least. So I would always take off those numbers. Now you can see here our entry point is 5920. Our stop loss, however, is 6010. Now, if we work out the difference between, that gives us an answer of 90 pips, because 5,920 away from 6,010 is 90 pips, or is 90, which would mean 90 pips away. So our stop loss is 90 pips large. Now, if we look at our entry point to our take profit, again, the difference between, so 5,920, so 5,920 to 5,850, that gives us a difference of 70, which means that our take profit is 70 pips away from our entry point. Now, that is just a simple and quick way of reading pips. You might be wondering, well, why is this even important? The reason why it's important to understand how to read pips or points in percentage and to be able to read the difference in prices in these markets is because when it comes to setting risk parameters, or when it comes to looking at our risk to reward ratios, this is how we calculate them. Now, on top of this, when it comes to calculating our lot size for the positions that we are placing, which is something we're going to touch base on in just a moment, again, it's important that we understand how to read pips or point in percentage. So I hope this example helps. If you want to understand points in percentage in greater detail, I do have a private series on the YouTube channel. So go ahead and check that out. Now, the two other things I'm going to touch base on is leverage and lot sizes. Leverage is essentially borrowed funds from brokers, which allows us to have a bigger role and a bigger responsibility in the forex markets. It allows us to place larger positions with the little equity that we have, essentially. So as you can see here, what I've written is, in forex trading, leverage refers to the ability to control a large position in the currency market with a relatively small amount of capital. While leverage amplifies potential profits, it also increases potential losses. So how leverage works is usually expressed as a ratio such as 50 to 1, 100 to 1, or 500 to 1. And here's exactly what they mean. So a 50 to 1 leverage means that for every $1 you have in your account, you can control $50 in the market. 100 to 1 means that for every $1 you have in your account, you can control $100. 500 to 1, for every dollar you have in your account, you can control $500 in the markets. So just as an example, let's suppose you have $1,000 in your trading account and your broker offers a leverage of 100 to 1. This means you can trade up to $100,000 worth of a currency, because 100 times 1,000 is 100,000. Now, without leverage, if you trade that $1,000 and the currency pair moves by 1%, you make a $10 profit. With 100 to 1 leverage, controlling $100,000 with your 1,000 deposit, if the currency moves 1%, you make $1,000, because 1% of 100,000 is 1,000, which is essentially 100% return on your investment. Now, if the market moves against you by 1%, your loss would also be $1,000, potentially wiping out your initial capital. So it's important that we look at the risk of leverage, because whilst leverage can magnify gains, it can also greatly increase the risk involved in the markets. So in summary, leverage allows you to trade larger positions, but it also demands careful risk management to avoid significant losses. So when I work on a one-to-one basis with my clients, and I try to educate my clients in a professional way, I always suggest and always recommend using the lowest leverage possible that the broker they work with recommends, just as this mitigates as much risk as possible when we do place positions in the markets. Now, I know some of you may want to use the highest leverage possible so you can make some crazy returns, but you've just got to look and think about the potential exposure you're going to have in the forex markets if they do go against you. Now, again, I hope that makes sense. I hope you guys have a better understanding on what leverage means. If you want more information on leverage in a deeper way, then go ahead and check out the risk management video. I should have popped it up by now on screen, but there is a more in-depth look at these risk management factors and how we can mitigate risk in the Forex markets. Now, the last thing we're going to touch base on within this segment is lot sizes. I'm going to try and run through this as quickly as possible, giving you guys a brief understanding on lot sizes. Again, if you want more information, go check out that risk management video. So in Forex trading, a lot is the standardized unit of measurement for the size of a trade or the number of currency units being traded. Lot sizes help determine how much currency you are buying or selling and directly influence the level of risk and potential profit or loss on a trade. Now, there are several types of lot sizes in Forex. You have your standard lot, you have a mini lot, you have a micro lot, and you have a nano lot. Now, a standard lot is the largest common lot size in the Forex trading, and it equals to 100,000 units of the base currency. For example, in a Euro US dollar trade, a standard lot would involve 100,000 euros. A 1 pip move would equal $10 when trading a standard lot on most currency pairs. Now, in a mini lot equals to 10,000 units. So it's 10 times less, meaning a 1 pip movement would equal $1 when trading a mini lot. Now, a micro lot, again, is a tenth of a mini lot, and a micro lot equals 1,000 units of the base currency. So as you can imagine, a 1 pip move would equal 10 cents when trading. Now, a nano lot, which is not something that is often used, it's only used when you have very small accounts and are trading with low equity. A nano lot equals 100 units of a base currency. Again, that's a tenth of a micro lot, meaning a 1 pip move would equal 0.01 cents when trading that size in lots. Now, it goes back to my point earlier about understanding how to read pips or points in percentage, because you can see here a 1 pip move would essentially mean you are going to either be up, say 10 cents, or you're going to be down 10 cents. So if we go and get an example up here, let's say that we have a stop loss here of 20 pips and we have a take profit here of 80 pips. For a start, we have a 1 to 4 risk reward ratio, which is great. It means that we are risking, let's say 1% of our equity, which would be 20 pips, to potentially gain back 4 times as much, which would be 80 pips, which would be 4%, because 20 goes into 80 4 times, so our potential returns is 4 times our initial risk. Now, going back to these examples here, if we traded with a mini lot, which would be 10,000 units, that would mean that if our stop loss was to be hit, which would be 20 pips, that means that we would lose $20. However, if our take profit was to be hit, we would be making $80 back on our trade. So you can see $20, a $20 risk for an $80 potential take profit is a great risk reward ratio, and it's a trade that would be worth placing. Now, you might be wondering, well, in this scenario and in this specific position with a 20 pip stop loss, who would be using a mini lot? So what you've got to think is, well, if you are only set to risk 1% of your equity per trade to try and mitigate as much risk as possible, the person placing this position would have to have an equity of at least $2,000. Why? Because a 20 pip loss of £20 is 1% of $2,000. Now, again, this is why it is very important to understand risk management, understand these simple points of lot sizes and pips, leverage, because these are going to be the things that are paramount to success in this industry. So I hope those brief examples make sense. I hope they've helped. You want a more in-depth look, as I said, please go and watch the risk management video that we have on the YouTube channel already. It goes into these 3 things in greater detail, and I can assure you that it's going to have a positive impact on your Forex journey. Now, next up, we have emotional trading. Let's be honest, trading Forex can be a real emotional roller coaster, especially for those beginners. 1 minute you're up, feeling euphoric, and the next minute your market turns against you and you're in panic mode. Forex trading requires a strong emotional discipline that many traders lack early on. Emotions like fear, greed, and frustration can cloud your judgment, leading you to make impulsive decisions like chasing losses or exiting a trade too early. You see, the market doesn't care about how you feel. It just moves. And if you let your emotions control your trades instead of sticking to a well thought out strategy, you'll often find yourself on a losing side. This is why having a solid trading plan and the discipline to follow it is non-negotiable if you want to succeed in the Forex markets. Now, this is another thing that I preach to my mentees. It is very, very important that you have a strong mind and you keep your emotions under control. Now, there's a few things that I can point out to avoid emotional decisions being made. Now, that is to have enough confidence in your strategy and your ability to trade the Forex markets, which in turn means that you need to have a trading plan and a trading strategy that has an edge and gives you a winning percentage. And you also need to have your risk management under control. You need to know when to stop. You need to mitigate as much risk as possible with every position. So that means placing trades with a risk of no more than 1 to 2%, taking partials throughout your trade, and applying safety measures to your position when the trade is playing out. Now, again, I've got a whole video series on creating a comprehensive trading plan. So if you haven't checked it out, go and check it out. But this is just another thing that is a key aspect to becoming successful in the Forex markets. If you can't control your emotions, you shouldn't be trading with live funds. Now, that actually moves us nicely on to segment 3, which is lack of risk management. Another crucial factor is a lack of risk management. In Forex, it's not just about how much you can make, but how much you are willing to lose. Far too many traders ignore this, and it's one of the quickest ways to blow up an account. For instance, using tools like stop losses, take profit orders, can save you from huge losses when the markets move against you. Something that I touched briefly on when we spoke about points and percentage, placing your stop losses and take profits, working out your risk to reward returns, and using the correct risk management strategies. Many traders risk way too much of their capital on a single trade. A general rule of thumb is not to risk more than 1 to 2% of your trading account per trade. And the reason for this is because if you were to risk 1% of your equity per trade, it means that it would take 100 consecutive losses to blow your entire account. With a 2% risk, it's going to be 50 consecutive losses before you blow your entire account. Now, if you have a trading edge and a strategy that works, you are eventually going to come into a winning trade. And if you are trading with positive risk to reward returns, so as I mentioned before, that 1 to 4 trade, if you're risking 1%, you're going to gain back 4% on that position. If you've taken maybe 2 losses, you're 2% down, you place that trade there, which gives you a win of 4%, you're essentially gaining back that 2% loss, and you're gaining a further 2%. So it's very important that you implement these things into your trading plan. But without a solid risk management strategy, it's easy to get caught up in the excitement and over leverage yourself, leading to devastating losses. So if you can't keep your risk management under control, you shouldn't be trading Forex. Now, segment 4 of this video is scams and fraud. This is something that is very common in this industry. Same with the crypto markets, stocks and shares, things of that nature. Anything that involves investing, trusting your money with brokers or trusting your money with mentors, gurus, online influencers, there is always going to be risk of scams or frauds. Now, this is by far one of the most frustrating aspects of the Forex markets. The internet, as I said, is filled with these gurus or fake brokers promising to guarantee returns and astronomical profits. I hate to break it to you, but there are no guarantees in Forex, and anyone telling you otherwise is likely trying to scam you. Now, these scammers often prey on new or inexperienced traders by offering unrealistic returns and easy money. But the reality is, if it sounds too good to be true, it probably is. Always do your due diligence when choosing a broker. Make sure they're regulated by a reputable financial authority, and avoid anything or anyone promising quick riches, because as we all know, there are no shortcuts to success. When it comes to my clients and the people that I work with, I always set expectations that there is no guarantee in this industry, and I give realistic returns based on my performance and based on the strategy I have and the success rate that it gives. Now, my tips for this is, as I say, always look for some kind of regulation when it comes to working with a broker, and when it comes to working with gurus or mentors, ensure that they have some kind of proof of performance and they have plenty of legitimate reviews and long-lasting clients. Now, I have a fairly small knitted client base, but the client base I do have is very retained, and the reason why is because of the consistency that I bring and the knowledge that I bring to the table. Once a client finds me and decides to work with me, the likelihood of them working elsewhere is very slim because of that. So it's very important that before you do work with anyone, you look into past success stories and you get feedback from some of their previous clients. Now, the final thing I'm going to touch base on in this video is high volatility. This by far is one of the biggest challenges of forex trading. Currency markets can move incredibly fast, and while that volatility creates opportunity for profit, it also creates just as much opportunities for loss, especially for traders who aren't prepared. So going back to the point earlier, when I explained how it's very important to have a good base knowledge on fundamentals, this is a key reason as to why. If there was some high impact news due out and you weren't aware of it, placing a position against the results of high impact news, this can result in some substantial losses. Now, it's easy to get lured in by the potential for quick profits, but let's not forget that some volatility can wipe out all of your capital in an instant. New traders often find themselves caught off guard by rapid market fluctuations and without a solid trading strategy. They can end up chasing the market. Navigating such volatility requires patience, precision, and most importantly, the ability to keep a cool head when the market gets chaotic. Now, my take home from this and my advice for volatility in the market is to simply not trade it. You want to mitigate as much risk as possible when you trade the forex markets. I always recommend using the lowest leverage possible. I always recommend using the lowest risk possible, 1-2% of your equity. And I always recommend avoiding potential times and periods in which the markets could cause such fluctuations. We have so much time when it comes to trading the forex markets. We have the beauty of them being open Monday to Friday, 24 hours. So why do we need to trade them when the markets are at risk of taking us out or causing us problems? I would much rather trade the markets when they are in more predictable conditions. Hence why I avoid trading when high impact news is due to come out. I think any professional trader and someone who has been in the industry for many years will always recommend mitigating as much risk as possible in any way that you can do. So if anything from this video, all I can recommend is to mitigate as much risk as possible when you are actively trading the forex markets. This is essentially your only way of being successful. Having a trading edge, following and sticking to your trading plan, and mitigating as much risk as possible in the forex markets. So there you have it, folks. Forex trading can indeed be a bad idea if you're not properly educated. If you trade on emotions, lack a strong risk management strategy, fall victim to scams, or are unprepared for the volatility. The truth is, Forex isn't for everyone, and that's okay. But, as always, there is a silver lining. If you're serious about Forex trading and willing to invest your education, practice with a demo account, and follow a disciplined approach, it can be a rewarding journey. The key is to treat this as a long-term learning process, not a get-rich-quick scheme. Now, if you guys found this video helpful, make sure you like, comment, and subscribe for more insights and tips. Let me know in the comments your thoughts on Forex trading. Do you think it's a good idea, or do you agree that it's not for everyone? Now, with all that being said, thank you guys for watching, and until next time, happy trading.